Let's get more on the oil market and the struggling energy giants with Carl Larry, live from Houston. Carl is a director and principal consultant for oil and gas at Frost Sullivan. Carl, good to see you.
Good to see you, Michelle. Thank you.
So, Carl, Halliburton reporting earnings today, and it showed that the company took a huge loss. Revenue was down 35% from a year earlier. They also reported a loss of $3.2 billion. But the company did signal that a turnaround is on the horizon for the North American market. What do you make of that?
Well, I think going forward, we're going to be a little more optimistic about prices getting higher. But we're also going to look at the way we get oil, the way we service oil. It's a lot more streamlined now. The technology's better, the production's better. It's a lot more efficient. So I think there's room for growth. I just don't know how much it's going to impact the employment situation that we've seen drop off in the past year.
Well, you know, Carl, we've been stuck in this 40 to 50 range for a while now. Is that the new normal?
It is for now. I think that, the way things are looking, especially globally, when you look at Asia and Europe, especially what's going on with the Brexit, the demand just hasn't picked up as we hoped it would this year. So as we move into the next year, as all these economies start to come back, we might see a new range, and that range may be closer to 50 to 55 or 55 to 60, probably on the higher end come 2017.
Well, as you mentioned, job losses, bankruptcies, and there have been dozens of bankruptcies in the U.S. oil sector. One of the biggest ones so far, Lynn Energy, with $10 billion in debt. We have seen a modest recovery in oil from those very low $20 lows. Do you anticipate more bankruptcies still?
I think there's room to find more bankruptcies out there, especially as we get stuck in this range of 45 to 50. It's not really giving anybody an opportunity to get back producing and making money again. But these bankruptcies do have a good side. A lot of these oil producing companies are still producing oil, but now with no debt on their record, they can kind of move forward and kind of bring oil back to the market a little bit cheaper with a lot less burden on their back.
Not good for the bondholders there, though. What price does oil need to be at for these companies to return to profitability, Carl?
Well, most analysts will talk about $50 oil, which is great. The problem is that once we get to $50, it slips back down, as we've seen recently, down to 45. I think what we really need to see is about $60 oil. That should give us a cushion back down to 55 or just even lower than that. But at least we know that we're well above 50 and can move forward going from there.
Carl, many oil analysts have been saying that this was intentional, that Saudi Arabia pushed oil lower to drive shale gas producers and smaller frackers out of the market, that it wanted to disincentivize U.S. companies as the U.S. was becoming energy independent. If so, did this plan succeed?
Well, they did manage to succeed in driving production down in the U.S. But alongside that, what they've done is actually we've increased our efficiency here. So we're producing more oil using less rigs, and the technology's really moved forward, especially when it comes to labor. We've been able to cut a lot of those costs out in the past year. So going forward, we're probably at the forefront of new technology and a new movement in oil production. So the Saudis were efficient in bringing oil production down, but we've really increased our technological side of oil production here in the U.S.
Well, what has the impact of these low oil prices and bankruptcies had on the oil sector? Can we expect to see more consolidation? Halliburton and Baker Hughes, they were trying to have a merger. They had to call it off because of antitrust issues. But is this a trend that you expect to see more of?
You know, Michelle, I do. And one of the things we can compare it to is the financial sector back in 2008, 2009. We saw a lot of small banks, a lot of big banks, I should say, merging and getting together and working together and building on that base. I think we're going to see a lot more of that going forward. To avoid bankruptcies here now, we're going to have to see these bigger companies come together and work together to keep building going forward.
You know, Carl, it's all about the supply and demand dynamics. And on the supply side, Libya is looking to make a big comeback. A rival government in the country, they've seemed to have agreed to merge their competing oil companies. If Libya does re-enter the market in a stronger way, what does that mean?
Well, it will mean more oil back onto the market. But what it also means is that a lot of these countries, especially in OPEC, are really struggling. They need to increase production to keep up with low oil prices and float their budgets. I mean, we see countries like Venezuela and Nigeria just unable to do at this level. So when you see oil companies within countries like Libya coming together, it really says there might be more oil on the future, but definitely there's an issue going on there with the economy and their budget.
You know, Carl, you and I have discussed this before, that OPEC is a non-working cartel. The last meeting yielding no results. Is there any hope of OPEC coordinating a production freeze?
I don't think there's a chance of a production freeze here or even going forward, but I do think there's more fracturing going on within that cartel. I think that a lot of these Middle Eastern countries really are just learning to fend for themselves. The Saudis have just gone on a very big tear here, not only just crude oil production, but storage, looking at downstream, looking at pipeline, looking at shipping. So you're really starting to see a lot of more countries within OPEC break away if they're succeeding.
And to that point, is it likely that we could see an alternative cartel being formed, something more formalized?
You know, I think we could. It's going to be tough for a lot of the countries on the fringe. So a country like Nigeria or Venezuela, it's going to be hard for them to find other countries to collide with or collude with. But in the Middle East, we could have a very strong cartel. The Middle Eastern countries are doing very well together. And I think if they banded together, we might see a very strong oil cartel come out of that area.
Carl, very quickly, Barclays coming out with a report today saying they expect oil prices to reach $85 by 2019. What's your outlook for that period?
Well, 2019 is a good far away. It's a good estimation. I think that as we see global economies recover, and especially as we see a lack of labor workers available that have switched jobs already, it could be we could see a very sharp spike within a year or possibly two. So I think 85 is a good number in 2019. I'm looking for about 60, 65 in 2017, and at least 80 in 2018.
All right. Thanks so much, Carl Larry, Director and Principal Consultant for Oil and Gas at Frost & Sullivan.